We had a question about strategy preferreds and what to do before the ex-dividend date. We're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about the markets and options and take your questions. For those who are used to seeing us on Mondays at 4:15 Eastern, I apologize that I couldn't do it, but I was actually just beginning a presentation in Sarasota at that time for the Money Show, and I am back in California now. Now, the only reason I really mention this is because I took the red eye to get to Florida, and I basically didn't sleep the day after that. And then I was on the air on CNBC at 2:30 in the a.m. this morning. So if I seem a little discombobulated, forgive me. I'm not operating on a solid bit of rest here. But that out of the way, so that is a bit of a disclaimer, I guess we could also say on things I might say today. I figured we'd get into it because we got an interesting question on a topic that is always near and dear to me, and that is Bitcoin and strategy and such things. And I don't know, are we able to populate this into the lower third? Because I don't know how to do. Great, there it is. Okay, so we got the following question. STRD is the ticker symbol. That is the perpetual callable 10.5% preferred stock in strategy. It's trading below $100 a share. I have it up on the screen right now. It is $79.75 according to Options Play. Let me just check something. That is interesting. Okay, so we're going to have to figure this out. So we have STRD was mentioned specifically in the post. But as I look at the preferreds that we have available to us, I thought I only saw one perpetual preferred that was at 10.5, and that's this one. So that is this share, and I have that at 98.20. So for whoever wrote that, Mike placed, I think that's in the name anyway, Mike placed 31.11. Maybe you could just, if you happen to be watching, perhaps you could confirm that for us, because it does seem like there's a little bit of a discrepancy. There is an STRD ticker, as we can see, but that is not the 10.5 perpetual preferred. That is something different. Well, let me try to look at both of these, and we'll see whether we can figure out together what it is that you were trying to figure out. So you said, does it make sense to claim ex-dividend December 1st and sell prior? So you want to claim the dividend on December 1st. Now, this is another reason why I suspected we might be looking at different instruments. So we have a 10-2 declaration date, but the X date for the 10.5s is actually, at least according to Bloomberg, on December 15th. So that's a little bit of a discrepancy there. All right, so I'm getting some additional information here. Okay, so I think the one that is showing up here is a 10% preferred. That's probably a QSIP. So maybe if we can get something like a QSIP number, that would be helpful. Because the ticker you gave does not match the description. There is a preferred stock that matches the description, the 10.5 perpetuals. But it's not the STRD ticker symbol that ties to that. and the ex-dividend doesn't match either. So I think there's a conflation here going on between the two. But why don't we resolve this a little bit differently and just ask the following question instead. And that question is, does it make sense to sell any securities that you have in strategy ahead of the determination about whether or not the stock is going to remain in the MSCi index? For those who are unaware, there is this is a risk that we've talked about it briefly before on the channel, but for those who didn't participate in those conversations, JP Morgan identified this as a risk, as others have too. And the logic that they have provided is that strategy isn't really an operating business per se, as much as it is kind of a fund of sorts with Bitcoin. So you'll notice, for example, that exchange traded funds and ETPs and ETNs don't generally find their way into an index. And so that's not to say that its exclusion from an index means that it's not valid as an investment, but it doesn't meet their criteria because the operating portion of Strategy's business is de minimis relative to the value of the company overall. And we can see that here. So if you compare the enterprise value, which is just basically taking the market capitalization and adding it to all of their debt, we're now at $70 billion. And the company's revenues from sources that were related to what they did before they became a Bitcoin treasury company are very, very small, right? So it's really not meaningful. To me, I actually am a little bit more interested in whether or not I think I'm getting to purchase a decent portion of Bitcoin or interest in Bitcoin at a rate that I think is likely to be more attractive than buying Bitcoin itself potentially. Now, Bitcoin has bounced back a little bit off of these lows, so we're now at 93,235. We'll just call it that. And we've said that they have about 650,000. Actually, I think the number is slightly higher than that now. So that gets us to about 60.6 billion. Now, there has been folks who say, well, it's not appropriate to think about the value of their Bitcoin relative to the market capitalization of Strategy because the company has a lot of debt. And this is true. But it is also true that the strikes at which some of the debt, that which is convertible is in many cases substantially higher. And we kind of went through that whole exercise last week, so I'm not going to go into each and every issue. But what I would recommend people do for their own sort of edification on this topic is you can go and take a look at the terms of each of these in kind. And I was going to illustrate this, except that, for whatever reason, this thing has now frozen up on me. Let's try this again. Let's see if I refresh the screen, whether it does its thing. Okay. This is STRF is the 10.5s. Right? Is that what you... Okay. Okay. So I'm going to go in here, and we're going to look at this one. And STRF. That's this one then. And we'll take a look at the dividends. Or will we? I don't know why this thing is giving me such a... This one seems to have... Ah, here we go. Okay. And nope, this is also X... Yeah, this one also has an XDiv of 12.15. So I'm not 100% sure where you're getting that 12.1. Yeah, so just a quick point. There's a possibility, given the date that you mentioned, that you are maybe conflating the declaration date with the X date. The X date is the one that matters. The declaration date is only when they officially publish, here's what's going to happen. But the X date is the date that matters to the shareholder, because this is the date that you need to essentially hold it through to receive the dividend yourself. So that's December 15th. And let's see when that determination is going to be made. That is, when's that going to take place? The determination on that is, okay, well, here's the good news. Let's see, the announcement and effective dates for the next 8 reviews. So there was a they published in November, and it looks like the next determination date is scheduled for January 15th. So here's the good news. All right. It looks like this discrepancy is not going to matter. So my attitude about it would be that, yeah, I think you can hang on to it. I mean, assuming that you're, and I am going to assume this is the case, that you are generally long Bitcoin, long strategy as your sort of underpinning philosophy. Otherwise, you wouldn't hold these things to begin with. So I don't think that there's any issue. You have plenty of time to act before the end of the year if that is what your concern is. And, obviously, if that happens, that could create some incremental selling pressure. I have previously stated that it does feel like there are some interests that are kind of leaning on strategy, leaning on Michael Saylor a little bit, and that can cause some incremental pressure. But I also think that the stock looks reasonably priced relative to their interest in Bitcoin right now. And the reason I say that is because there are those that are saying, okay, you take the value of their Bitcoin and you divide that number by their market capitalization, and if that number is greater than 1, then effectively that's what the shareholder gets. That's not entirely accurate because, as we pointed out, you have convertible securities that are on their balance sheet and they are entitled to some of the upside. But I have also pointed out that many of those are not convertible until strategy stock is at higher levels, and in some cases, much higher levels. There are some that are struck around 433. There are others that are struck around $650. With the stock where it is right now, you are effectively getting a call spread on Bitcoin up to those levels. And those are big, big differences. And by the way, that's a call spread that applies to the share price. So it is possible that the share price could go up even if Bitcoin does not. Do I think that's going to happen? Well, that would mean that strategy is going to start trading at a multiple to the value of the Bitcoin that they hold on their book. I don't know that we're going to get back to the kinds of multiples that we've previously seen, but it can certainly trade at a premium. I also believe, though, that it's probably not going to see a much bigger discount. I've pointed out on more than one occasion that I thought this was an attractive level to get involved on a relative basis, and I still feel that way. So you have time, if any of you own the preferreds, to make that determination, it looks like, because they're all going to be paying on the 15th, or I think most of them will be. I didn't check every single one, but I assume that they're probably doing it on the same time. And there's probably a solid month to go before the MSCi determination is made. With that, let's take a look. Dividend degenerates. Afternoon, Mike. Great space with Wolf Financial today. Yeah, for those of you who don't participate in that, I didn't really do a lot of X spaces until I started to participate with some of the stuff that Wolf does. And, they're not all the same, but it's an interesting opportunity to actually talk to other people, to have them ask questions. And so, where this forum that we're doing right now is helpful because we can interact in real time and you can, put questions in and we can sort of look at them together. The nice thing about X Spaces is that everyone gets to talk to one another. So someone can just be brought up to the stage, turn the microphone on, and have a conversation, which I think is great. That's the good news. The bad news is that X Spaces in recent weeks, for reasons that I don't know, hasn't been uber reliable. So I used to actually connect to it through this same setup that I'm connecting to this, even though I didn't necessarily turn the camera on. I have a microphone up here, and it's all plugged in, and it's all great. For the last couple of weeks, I've had to use my phone, and the PCs haven't been working. Either I can't hear them or they can't hear me. I don't know what's going on with all of that. But yeah, so I had to use this. It just seems a little bit off. It's okay. I got some AirPods recently and trying to keep them hidden from my kids so they don't end up going through the wash or getting lost or stolen or whatever happens to most of those. So it works. It works okay. That's the only knock on Spaces that I have, though. Really, is that I think being able to show stuff and is helpful, and it's not super reliable. 11506 Stephen. Every time I read about the strategy financial juglery, let's see. Oh, okay. So, here we are. The MSTR financial structuring only ever seems to get more complex. What this type of financial innovation taking place in the late 90s? So, financial innovation, it's not always so innovative. Creative might be a way that you could describe it. Look, I mean, mezzanine finance, there's always folks who are out there trying to come up with new financial instruments, new ways to raise money, and sometimes those are good, sometimes they're not so good. I think we saw in the credit crisis that you can create some perverse incentives at times, and it's not that any given structure by itself is flawed, but you can build a system of financial innovation that tends in an unhealthy direction without adequate guardrails in place. So taking apart mortgage bonds and saying, okay, we're going to put principal in one place and the interest someplace else, trying to bunch certain types of securities together and, do swaps where you can do fixed versus floats and all these kinds of things. Do they all have utility? They all have utility. The problem is that oftentimes you remove the risk from the underwriting side as that happens. And that is problematic in financial circumstances. So when the people who are making the determination about money being loaned is not they're not risking their own capital to do it, this becomes a little bit problematic. And so in this particular instance, what are these guys up to? Well, these guys are just trying to acquire more Bitcoin. They think Bitcoin is going to 1 million, and there is a limited amount of it, and they want to own as much of it as they possibly can, and they will borrow money to buy it. The way they were trying to do that originally was, I thought, quite creative, which was that they were saying, okay, well, we're just going to sell long-dated, out-of-the-money call options effectively on our own stock to borrow money now to do this. And from their perspective, and I think it was largely correct, the immediate appreciation in the underpinning Bitcoin as an asset would accrue to the shareholders first, and then to the holders of the convert second. So that met their needs. It met the needs of the existing shareholder base. And in many cases, it met the needs, believe it or not, of the people who are buying the preferreds, because we also, the preferreds later, but the converts. And one of the reasons was because there are investors out there who were ineligible to buy Bitcoin directly or even strategy stock directly, but could buy the convertibles. And it had a very desirable hedging effect, as we illustrated. People can go back and find that video. But essentially what we showed was that you could do a really small allocation to those converts or to the preferreds, to something on the fixed income side, and create a meaningful bump to the performance of a fixed income portfolio, enough that it could take you from being in the bottom quartile of fixed income managers to the top quartile by having even a very relatively small allocation, because it appreciated so meaningfully when Bitcoin went up. And still, your risk was capped at, well, whatever you invested. But in something that has as much volatility as Bitcoin does, that can have a powerful effect, particularly if it's likely to appreciate at exactly the time that you would need something like that as a buffer for a fixed income portfolio, which is when the dollar rolls over, or when rates go up. And actually, we've seen that. We've seen rates go up and the dollar go down. Usually they kind of move together because one's considered an inflation hedge and is supportive of the dollar. So you would kind of hope that short-term rates and the dollar would move together unless something's starting to break. We've seen some other evidence that might be true. But yeah, it's a bit tricky. It's not perfectly clean for me to say, oh, okay, well, you shouldn't be concerned about increasing complexity in financial instruments. It's something to pay attention to always. And whenever a new product comes out, there may be malevolent actors out there who are inclined to use it for their own devices in ways that is, not that great. So there is that. Adobe seems to be left for dead. Thoughts on calendars? Buy the March 330 at the Monday Long Calls. Post next quarterly earnings release for 30 and sell the January 380 for 5 against it. Shall I wait until after the next quarterly earnings result on December 10th? Any thoughts? Let me offer some thoughts on Adobe. Two different contexts for this. I have to say that as a company, I felt like Adobe had increasingly become a business that was all about trying to optimize their subscription fees and maybe not optimize the products that they were offering. Every single person who's watching right now has at some point or another used an Adobe software product, installed it on their machine, and probably thought, oh, geez, how do I get rid of this thing? Like it's part of my machine every single time I boot it up. They're resource hogs, and it just seems like every which way you look, it's a way to try to milk a licensing or a subscription fee out of you. If you happen to use it for other things, so for example, if you produce videos like this one and you use some software to do that, they do have some competition. There's a company called Blackmagic that makes a product called DaVinci Resolve. And DaVinci is a competitor to some of the things that Adobe does. And there was a time when Adobe kind of had a lock on it, but now Blackmagic is starting to play nice with others in the space with whom they are competitors. So Apple used to have a big share of this business, and they have certain software protocols essentially for recording video, among other things. And that didn't play nice with every platform, and it didn't play nice with DaVinci. That is no longer true. And their pricing is much more attractive, DaVinci's that is. And so if you were recording things in ProRes and you didn't use DaVinci because of that, now it's pretty much as easy to do that as it is anything else. So I feel like their business is a little bit, it's under a little bit of pressure here. That said, it is not hugely expensive, as we can see on my screen right now. So if we look out to 2026, we're looking at $23.38. And that is, so we'll just call it 327. I mean, less than 14 times forward with a 12% growth. And, that's quite a juicy free cash flow yield, it must be said. So 10,364,000,000-ish is what the street's looking for versus 137.5. We'll just use that. 7.5% free cash flow yield. Expected to grow at 11% year on year. It does tick a lot of boxes. I don't own it. It is... I'm really caught here because, like I said, as a company, I feel like they just constantly have their hand out. They're trying to figure out how to get more money out of you no matter where you are in their product offerings. But they do have a big user base. The company is still growing at a decent rate. That's a very attractive free cash flow yield. And it's a cheap multiple. You know, I suppose, you know, one way to look at this, a decent way to look at it, I would think, is that, you know, every investment's going to have some hair on it of some kind or another. A great company that's doing absolutely everything right, chances are you're not going to get that one super cheap. But you're going to buy it because you think, at this growth rate, 18 months from now, whatever premium I'm paying over what I might have hoped to have to pay will easily have been justified. This falls into a different category where at a high level, all of the financials just make it seem like you're just getting something very cheap. And that certainly looks that way here. I mean, you're talking about a business that is growing faster than the S&P or is expected to. This is the important part. And is trading 10 turns cheaper. So that kind of feels like a no-brainer in a SaaS model. And, you know, for a while that was everything, the SaaS model. I do think that, you know, my own views here are probably a little bit jaundiced. So I'm giving it some thought. But I think, you know, I mean, valuation-wise, it's certainly not problematic. So let's take a look at the strategy that you propose and see what that looks like. So I'll let, and you know what, if any of you have experience with Adobe, I would love to hear somebody explain to me why this is a business that is not at any risk. Tucker D Dog says, everywhere I see people looking for any substitute for Adobe products on video editing, photo editing, layouts, not necessarily one shop to compete with all, but many sort of chipping away. So Figma for UI UX design, Resolve on video editing, GIMP, etc. on photo editing. Yeah, that seems to be my my take on it as well. But let's just build this structure, and maybe, so you want to buy the March 330s. And you want to sell, I'm going to put this up, and sell the January 380s. Against it. So we end up with a structure that looks like this. And let's take a look at their anticipated quarterly earnings release schedule. So we can all have that in front of us. So December 10th and January 12th. So January 12th, having that, the benefit there is that while you could experience some vol crush in, you know, call it the 60-day options after they release earnings in a week, next week, because it captures March, you might keep a little bit more of a bid. Of course, that's going to be, we should probably sort of see where vol is just in general and compare that to, so we're going to put in today's surface, but let's go back in time a little before we pick out the other surface. I mean, this thing has really been What was the all-time highs in this thing? Oh, wow. That is a tough-looking chart. But I guess you could argue that one is shooting against this low, which I assume is something you're thinking of. But yeah, that is a tough-looking chart for sure. Although the volatility does seem to have come in a little bit. Maybe we're reaching a critical juncture here. And let's see. So we're going to take a look at vol relative to the beginning of the year. And this is what a bunch of these technical indicators have to say. Kind of a mixed bag, but you know, the top 4 best performing technical indicators on this one, at least over the course of the last year, are bullish. And by the looks of things, have fairly decent returns. So that part is good. So let's go back to the vol. So what I'm looking for here is, I'm just going to go back to last year. I just want to see how much higher volatility is. Because one thing that would concern me a little bit would be that if one of these results soothes investor concern, and they clearly have concerns, the stock wouldn't be behaving the way it has done all year if that weren't the case, that could prove to be the vol crush event itself. And it looks like vol is comfortably of a similar tenor. So if we're looking at that, we're looking at March here. That's 41.7. And if we go back a year ago, it was 31.7. And now let's take a look at how this was after their earnings result. Let's see. Oh, did I miss? You know what? That I may have screwed that up. Bear with me. This is actually, it's good that I screwed it up, because if I did what I think I may have done. Yeah. Okay. So they reported on December 11th last year. So we need to actually go back to this chart. And yep, that's what I thought I did. We need to see what this looked like. Well, let's just go back to the 3rd. All right. So March was 36.7, and I said this is 41.7. And it dropped. So we'll go to just a couple days past the earnings result. Okay. That should be 2024. No, not 3rd. Like this. Here we go. All right. So what are we looking for? We're looking to see what happened to the March expiration options, the vol crush that happened to those options after they reported last year, to get a sense of, you know, let's just assume, I mean, I think we can agree that this chart, which, that plot right there, looks fairly similar to this one, right? So that was December 3rd last year. This is December 3rd this year. Earnings for March are captured here. Earnings for March are captured here. So how much of a decline did we get in the expiration that you are looking to buy, such that now a more robust assessment would probably say, okay, maybe we look at a number of these and compare them. But basically, we declined from 36.7 to 32.4. So that's 12.5%. That's 41.7. So let's assume that's 36.8 in terms of vol. That's a difference of about 5 clicks of vol. So on a standstill basis, we can from that number, we can now say, okay, well, let's just assume that you get a comparable decline in implied volatility from before the event to immediately following it for the option that you would buy, in this case, those March 330s, and estimate, just absent everything else, how much money that ends up costing. And that's the vol crush number. Assuming that you just get the same move in vol and the stock does absolutely nothing. So for that, we need to know the Vega. And the Vega is 42.85. Oh, no, sorry, that's not the Vega. That's not right. 0.69. 64. That's the vol. Sorry. So that's a difference of $3.50. So in this trade, you're going to lose $3.50 in vol using only that one piece of data. So we'd have to, ideally we'd assemble a whole bunch of these. But I bet that's probably realistic. It could even be higher. But you're going to lose $3.50 per contract, $350. So this is we'll call it a $3,050 contract. You're going to lose, $350 on a standstill basis on the long side. The calls that you are short, their extrinsic value is essentially going to be eviscerated, because as you look at that chart, those options are not these. They're going to be like these. There we are. So those things are 43.5. That's this. Those went from 39 to 26. So for an option that's that far out of the money, it's essentially going to take it to zero. And we can confirm that by just doing the same exercise. So now we're going to go here. Here's your Vega number right there. This is a $4.50 option, give or take. And yeah, I mean, that was 10 clicks of vol that was coming out of those things anyway. So virtually all of the value of these options, if the stock does nothing, goes away just because of the vol crush. So that means that it's kind of a push, right? So then what's the next question? Well, the next question is your delta. And the delta is going to determine your profitability from there. These are not going to have any delta unless Adobe really takes off. And if it really takes off, as we saw in the chart, that's a win. So in the more modest outcome, the more modest scenario, where you're going to be somewhere in here, it's less risky than actually just simply going out and buying the stock. So it's not a bad trade. You will not, I guess here's one way to put it. You're not going to make money on the vol crush in that calendar based on the current prices for options as I see it. At best, it's basically a push. The vol that you lose on the front January options versus what you gain. Best case. But it does mitigate the vol crush and give you some convexity with a cap on the 380s, which would be quite a big move. In fact, actually, let's just take a quick peek at that now and just say, okay, well, 380 versus the 330 stock price that we have right now, how often do you see something like that take place? So, What are the biggest up moves that we've seen? We did get one here back on June 13th, 14.5. And even then, that's all right, because that basically just runs to your short strike. And what do we say? You know, we want, with options, we want the stock to run through our long strikes and to our short strikes. So back when they did their Q2 24 earnings back in June of 2024, we had a move of about that size to the upside. And then, again, we had one back in March of 2020, which doesn't really count because that's the pandemic, so I'm not even going to think about that. You know, I think it works. I think it works. The jury's still out on Adobe itself, though. That's the only problem. That's the problem. I think it's a decent way to mitigate the problem with a vol crush on the longer option you want to buy, because you're paying up for that thing. As you saw, I mean, it's comfortably 10% more money than a comparable option was at this time last year when they reported. But the other thing I would also say is take a look at the price action that the stock has seen after they reported, and you will recognize that paying a premium for some optionality is well worth it. I mean, we have a lot of double-digit moves in here. So I like that. Okay, Route 123, thanks for all you do, Mike. Can you please tell us what you see in Microsoft and Amazon? Amazon, I see a stock that I like to own. It is a stock I've mentioned many times. So, yeah, I like Amazon. Kind of a full stop there. Where do we begin with it? Trades at a market multiple, growing much faster. The big reason to buy Walmart is because they could achieve the things that Amazon has already done, and so therefore people are willing to pay 12 turns more for Walmart. Doesn't make a whole lot of sense to me. They touch AWS. They've got an AI play. They've got a streaming play. They execute. The trend is their friend. I'm not really sure what else I can say about it. It's kind of evident. Every one of you watching probably going to have umpteen Amazon boxes sitting outside your house almost every day from now until the new year. So, yeah, there's a lot to like there. Microsoft, this one, the valuation was a little bit tougher for me. We'll see where they're at right now. They have managed to justify it, I think it would be safe to say, but it was just a little bit richer. But it's not that much richer. You know, it's trading a little bit above its long-term averages. So remember that if you are to the left of the orange diamonds, that means the company is trading cheap relative to its own history. And if it is trading, at least on that metric, and if it's trading to the right, it's expensive on that metric. And we can see that it's about fair on a price-to-book value basis, and it's trading at anywhere from an 8%. You know, I mean, there's a bit of a premium here. But you can see this is the price that the stock would be if it was at its own historical levels. So you can see it's a little bit high, anywhere from, I don't know, just a couple percent. So it's not terribly cheap. But, I mean, this is a company that executes, right? So does it hit some of the other metrics that we like? It certainly does so on the top line. Great numbers. It certainly does on the bottom line. Great numbers. It certainly does in terms of free cash flow. Great numbers and growing, right? All of these things are good. They're embedded. They're in the AI play. They compete with AWS, with the Azure products. And you can see I obviously use their products. Not enamored of them all the time. I'm not enamored of everything on iOS either, so we can take that for what it's worth. So I'm fine with Microsoft. If somebody says, you know, buy, sell, or hold, I would say if you like it, then that's fine to buy that one. This is not one of our holdings, though. Again, so always reasonable for me to share that we don't own it. We do have a piece of it, but it's in a fund only in funds that kind of have to own it anyway by virtue of what they are, either because they are, say proxies for the top 50. So that one's obviously got it in it. And then we have a covered call fund that's sort of dedicated to it. So we do have it in those, but we don't have it. We don't have it in our discretionary funds. But it's a fine company. Just for the reasons I said, I think it's fairly priced here. But if you really like it, this goes to what I was just talking about earlier when I said, you find a great company that's executing and has done so consistently year after year after year, and you say, am I willing to pay up a little bit just so I can put this one in the portfolio, knowing that 18 months from now it's going to all be fine? This would fall into that category. So I hope that helps you. But Amazon, I like it. I saw something here for Netflix. Where's that? Good morning, Mike. Welcome back. Hope I can catch you at the Money Show when I'm back in the USA back in 2026. Yeah. And you're also following that same schedule, 2:30 a.m. Man, that's not easy. Awake and alert. Maybe I would have been really alert at 2:30 this morning if I had not already flown back and forth across the country within the prior 30 hours. That would have helped. Okay, let's see. Netflix is down 5%. Is it an opportunity to buy? Well, any discount on a stock that we like is arguably a chance to buy. I think what we want to look at here, though, independent of the fundamentals, let's just take a look at the technicals because the chart did seem to have some cracks in it. You folks will know that I do like Netflix. I have described them as kind of an unregulated utility. I think in the streaming wars, there isn't much of one. I love the fact that Amazon's got Prime, but Netflix has basically won this. We're below the long-term averages, and I think that's a little bit problematic, to be honest. Now, like I've previously mentioned, we do own this one, and we have not sold it. I have friends who are in this thing and have owned it for a long time, and they have not sold it. But there's a comment that often gets made which isn't entirely true. And the comment I hear made is someone will say, well, I own it, and therefore that's the same as buying it today because I haven't sold it. No, it's not. No, that is not true. There are reasons why we own stocks that we think like, when this thing broke through the 50 back here and, we had a lot of sort of weakness, you'd say, well, the valuation was a little rich relative to its own history, and then you watch it sort of struggle, and then you had this downward price gap right there, and you would have said, you know what, it goes below the 200, and I'm gonna ditch it because nothing good happens below the long-term moving averages. And indeed, it's gotten, it was under, it came back to the 200, and then failed again, and now it's lower still. So why is it not the same thing for somebody who, like us, owns it but hasn't sold it, to say that's not the same as rushing in to buy it here? And the reason is taxes. Right? So at least one person I've spoken to about hedging approaches and techniques, I've previously mentioned this person, not by name, but I've described that his basis in the stock, I think, is $200. $200 on a pre-split basis, right? So we'll call it 20. That basically means that the entire share price is capital gains for him, and he's in a high tax jurisdiction. Well, that means that if he sells the stock here, and he's taking in, an $84 capital gain, and he's going to have an effective tax rate on that of probably close to 35%. That means that's a lot of taxes to pay. So he's not selling it here. He's selling it at $75. And the multiple at 75 is different, indeed, a lot different than it is where the stock is here. So, my thinking is just based on the stock pattern. It looks to me, so he would be selling it at 25 times earnings on a 20% growth rate, net of tax, if he sold it here. Sadly, we don't have quite the same gains to book in it, but still, you're selling it at the net price, not the gross price. And you might say to yourself, okay, well, at the net price, I don't want to sell it. I don't want to sell Netflix at 25 times forward earnings. I'd rather buy it there. That's not the choice I'm being offered. But I would say, if you're interested in getting into this one, I would probably sell some strangles around it with a long delta. I think that's probably a decent way. I think it's gonna struggle at the 200. So what might that look like? Why don't we just build one so we can see? Because like I said, I like the stock. I think they're doing everything right. They're best of breed. They hit the numbers on a lot of other things. Now, you folks know that when I run my screens, one of the things I do screen on for buying opportunities is the momentum, and the momentum right now isn't great. So it ticks a lot of the boxes, but it doesn't tick that one. So this, it would be a violation of our rules, I guess you could say, to rush in and say, okay, well, we're going to pick this thing up here. But you could do something like this. So if you were going to sell a strangle against this with a long delta, we'll pick out, and then I was just being asked this, actually, interestingly enough. I'm going to be looking at, say, a 30 delta put on the downside. And then on the call side, I want at least an 80% chance I'm not going to get shot. The other thing I want to take a look at is, let's take a look at that 200, right? Because that 200 is probably a decent thing to lean against. And that's 113.91. Call it $114. Now, we're not going to probably be able to sell the 114 strike call, or can we? No, the 115s. There we go. So you get something that looks like that. And maybe it's more helpful if I actually use the open interest one to chart this out, because then we can see... Or can we see? Why can't I scroll up now? Come back. I wanted to just sort of, I can draw on the chart, but I was going to let this one do the drawing for me. There we go. So we were just looking at December. No, I was looking at January, excuse me. And we're just ripping right along here. This is probably my PC, by the way, which I left running the whole time. It's probably choking on something. And I know we were selling the 115s. And which were those? 98 puts? 99s, okay. So this is basically what you're going to end up with. So this is this chart is 2 standard deviations now. And we know that the 200-day is coming down around like that. We saw. And, we like the stock, so potentially getting long at 99, less the premium you collect, which is close to $4 now. So, looking at $95. And this kind of goes to what I was talking about before, where the valuation is not where it is right now. The valuation is your net valuation. So in the same way that I was saying, if you sell it and you have like a $30 tax bill, you're selling the stock at 25 times earnings. Well, if you sell this strangle and you end up having the stock put to you at 99, 95 is your effective price, you're not buying it at the current multiple to forward earnings. You are instead buying the stock at 30 times, just under 31 times forward with a 20.2 growth rate. So 1.5 peg. That's not bad. So I would probably lean in that direction rather than just reaching out and buying the stock here. I mean, you could do a buy right or something like that. I think it's going to struggle at the 200. That's my thinking. It does feel like there's some sellers out there. That's probably the reason why this thing is underperforming. Let's see if there's some record of some real money accounts letting this thing go a little bit. So yeah, we have a couple that are letting go of some pretty big pieces. And some of these are real money accounts. See, we've got Wellington in here. They're selling a big block. Fidelity. Couple other participants. It's just weighing on it. So it's just a little heavy here. Still like the company. If you own it, especially if you own it as we do and other people I know and have a real tax burden to pay, do I think it's worth selling it and losing it? Maybe you don't have the basis that my buddy does, but is it worth selling the stock at 26.5, 27 times earnings with that kind of growth and that backdrop of a story? I don't think so. So I would hang on to it and I just write some premium against it. Once it gets definitively back above the 200, though, that changes things. Whichever long-term average you use. Is it 200, the 150? I'm using the 200 because that's what it just defaults to. I know that Carter prefers the 150, and I understand from having spoken to him on more than one occasion that he actually has some data in support of this, but a lot of systems don't default to that. And, you're just auto-drawing trend lines, so you just need it to get out of this bearish trend, and it hasn't done it yet. Okay. Alex says Snow just dropped on earnings. Dividend degenerates with AI throwing money at infrastructure and power. What do you think about the software to run it? Yeah, I mean, so one of the other things I had said, I liked Vistra Energy on the energy side. I think there are a lot of derivative plays like this that you can get involved in. Here's the one bit of caution I would offer as we think about this, and it's one of the reasons why. I wrote an article about this end of last week, getting rid of NVIDIA. And I said at the time, I think NVIDIA is going to be the most profitable company in U.S. history next year. I mean, it's going to be the most profitable company in the S&P. It's going to have the highest adjusted net income of any business ever, U.S. business ever. But the problem is that in order to continue to really deliver for shareholders, the company's going to have to grow at an astonishing rate. Eventually, it has to converge to GDP growth rates just because of its size and scale. And, you're talking about a $5 trillion company. So if you think about what Alphabet did this year, was the stock up like 60% or something so far this year? Well, if you wanted to get, can NVIDIA at this point contribute to those kinds of gains? Oh my gosh, it's up even more than that. Oh no, yeah, I was right, 68%-ish. Okay, so that makes sense. In order for NVIDIA to do that, or even closer to 70, you're talking about adding $3.5 trillion of market capitalization to deliver that kind of performance, just because of how big that company has gotten. And that is 12% of the U.S. economy. Now, is it because they don't have a great product and there isn't huge demand for it, and that demand can't persist? That's not the only reason. My problem is that once they've become the largest company and a massively profitable company in a country with a bunch of governments that just can't get their fiscal house in order and are forever looking to reach into somebody else's pocket, I just think you got a target painted on your back. And I think they have one. Then I think, well, would I rather have Alphabet or NVIDIA, and I feel like Alphabet is cheaper and it's a little better diversified, and they've got some innovations coming down the pike, and they've got multiple lines of business, and they could step away from the exposure to AI in terms of its focus. So if I was going to say, would I rather run something like a long synopsis trade with something else? Oops, why did that not work? With something like an Alphabet, I think the answer to that is, I think I would. Because this just has, this has more room to run, and they're just not going to be in the crosshairs as much. So, yeah, I think that's fine. And you can see right here, this is not terribly valued either. And in fact, even with the expectation of margins falling, which we can see here, we're still looking at 33 times forward with a 36% top line anticipated growth rate. If they were able to keep their margins where they're expected right here, then this would be a very different picture. Maybe it seems reasonable because those margins are much higher than what we've seen in the past. But, yeah, that's okay. Let's take a look actually at their earnings. So, what's the options market expecting out of these? 8.5%. Is this thing cheap enough? And are the options expensive enough? I had quite a run just going into the print. That's a little interesting. All right, well, let's take a look at what the options are telling us here. So, what's this? The average move is... Yeah, I think the average move of 5% is really not what's relevant. This is what's relevant. I think it moved 36% last time. So the straddle now for next week. Let's look at the 465s. $40. So 8.6%. Expected move between now and a week from Friday. I'm not sure that's enough given the moves we've seen. But it's let's just show you what the break-evens would look like if you did something like this most recent run that we had. Where did I put my options play? There we are. Okay. So this most recent run that we've seen, this is the kind of setup where if I'm going to lean long, I'm more inclined to use something like a call spread risky. This is more of just it's just on strict deltas. Like, okay, I've got this event coming up. Really don't know how it's going to turn out. Options are... Well, at the very least, they're fairly priced. I want to take advantage of, some potential vol crush that's going to happen, but I also want to have some potential upside as well. So I might do something like this, and like that, and sell something down here. Go like that. That rather than buy the stock just to mute. I mean, do I think that this thing is going to gun all the way through 550 that's a big move, right? So And actually, the standstill rate of return here is probably a little bit better because you're short 2, long 1. So I think this wouldn't be a bad play. Something like a call spread risky. And let's just take one last look at that chart. Your downside really comes to you around 410. Let's have a look at 410. Yeah, and look where that puts us. That's just a happy coincidence. So you end up owning it right in here somewhere. I think that's a decent way to play it. Certainly, I would do that before I'd buy the stock here. And I'd kind of like to have a little piece of this and own Alphabet. And like I had previously said, I mean, 5 of the top 10 largest companies are all in the same space. I mean, it's, you know, we should be a little cognizant of getting over allocated to the trade. And, you know, that's coming from somebody who helps collaborate on an actively managed fund where there was supposedly some diversification, but where conditional correlations bumped up fairly substantially when, you know, higher beta stocks started to roll over, net of what happened in Bitcoin. And don't want to see that happen to you. So just think about that concentration issue. Vistra, by the way, which is on the energy side, I still think that one's reasonably priced as well. Although that one's done pretty, it's up a bit, but it's not grossly expensive. Okay. Netflix is making a bid for Warner Brothers Discovery. If they win the bidding, does Netflix go lower? You know, I don't think so. Usually that is the way that the acquirer is going to come in a bit. The thing is that this is not... Let's just take a look at the relative value propositions here for a second. I'll make a point to reboot my machine before the next time we do this. So here you've got almost a $500 billion business. And here you have a much smaller one in terms of valuation. I think there are some synergies. I think they would know how to take advantage of those. It's not a great growing story, but you know, I assume that I have decent faith that management has some ideas. You know, it's interesting. We have also seen that there's an interest in jamming Warner Brothers and NBC, like the legacy NBC properties together. Is that going to happen? I don't know, but I don't think it's a big problem if they acquire it. Man, what an opportunity that was, though. This actually does speak to sometimes the dash for trash can pay off, and this also speaks a little bit to that power law issue, which is that, you know, sometimes a real boost to one's portfolio comes in the form of, you know, something that you didn't really think of owning. It's one of the reasons that cap-weighted indices sometimes can do so well. This is a stock that, you know, off of the April lows is up 226%, which is something, incidentally, that cannot happen to a company the size of an NVIDIA right here. That'll never happen. Never. I shouldn't say never, but it's not likely to happen. It's not likely to see a $5 trillion company trade up to 15 in, you know, 8-9 months. Okay. I use PDF Gear on my computer for anything PDF related. Why bother with Adobe? It's just maddening. I agree. It's and that's I think that's why the stock is trading at such a cheap valuation, is that people are just saying there's too many people who want out of their product suite, and because of that, those numbers are just too ambitious. And I think I have shown you guys this. If you want to see something that doesn't look too good, look at the performance of stocks that are seeing revenue or earnings, negative earnings or sales revisions. So we can actually take a look at that right here. And if that's what we're in store for, and I think that's what it's pricing for, this is what you get. Things that are getting revisions land in this kind of bucket in terms of monthly performance versus the ones that are getting upgrades landing in this one. So I think this thing is trading very much like those numbers are due to come down. And, but, it is cheaper. So, and we've seen, Warner Brothers is an example that sometimes, that can also pay. Okay, so I have really chewed up over an hour of your time today, and I apologize that if it seemed at all disjointed. I'm trying to chug coffee here as fast as I possibly can, but its efficacy diminishes once you decide to extend your lack of sleep beyond a couple of days. You're if you go to bed at 10:30 and you decide to stay up at 12:30 and drink a bunch of coffee at dinner, it'll probably work. But if you're running on a minimal amount of sleep for 2-3 days in a row, coffee just doesn't do anything but make you feel jittery. So only did a little for me today. But I appreciate those of you who tuned in, who asked your thoughtful questions as always, and I'm happy to try to work my way through at least my version of the answers if and when I can. Like, subscribe, hit the notification bell, and come back and watch us again next Monday, 4:15 Eastern Time. Thanks for watching.